Hello, everybody, and welcome to another episode of the Scaling Alpha podcast. Today, we're joined by Ted Hicks. We're diving deep into the realities of portfolio construction, drawdown protection, and why surviving the short term is the only true way to compound wealth over the long term. Ted is the founder and chief investment officer of Hicks Associates Wealth Management. Ted began his career in February of 1999, right at the doorstep of the dot-com collapse, and navigated through the 2008 global financial crisis as well as me, and I did as well. Those defining market cycles led him on a mission to challenge standard Wall Street dogma, integrate rigorous technical analysis, and build rules-based frameworks designed to protect wealth during the major market storms. He is also the author of the book Evidence-Based Investing: To Invest Well Over the Long Term. Sometimes you have to survive the short term. Welcome to the show, Ted.
Thanks, Ben. I appreciate you inviting me. Happy to get the opportunity to chat.
Fantastic. I want to first say I read your book. It was a fantastic read. I appreciate you sending it over before the podcast. I feel I learned a lot. So let's just dive into your early career. So you entered the wealth management industry in February 1999, right before the dot-com crash, and later managed clients' portfolios through the 2008 global financial crisis. How did experiencing those two massive bear markets in your first decade in this industry shape your core investment philosophy?
Ben, you remember the story, I told it in the book, that during the dot-com crisis, I graduated from NC State in December of 98 and joined the firm in 99. So when the market started crashing 13 months after I started the career, at some point the industries, or not the industry, but the firm's leaders, they were telling me that this is a once in a career crisis. It's good to get it over at the beginning of your crisis, or it's good to get it over at the beginning of your career. And I thought, well, that kind of makes sense. And so I was young and naive and didn't know any better and thought, okay, I'll just soldier on. So I soldiered on, and the global financial crisis came just a short few months after I had bought my wife a brand new minivan and a bigger house for our growing family. And the firm's message to me was awfully similar to what they told me during the dot-com crisis. And I remember thinking, how many of these once-in-a-career crises must I go through? And that's really when the proverbial scales began to fall from my eyes, because, Ben, we were doing all of the things that the industry teaches. I was doing all of the things that academia teaches. All of our clients were diversified, we're focused on the long term. We have a asset allocation policy, that we're adhering to, and we all still got punched in the face. And so that really just began a journey for me to say there's got to be something that I'm missing. And that's ultimately what led me to doing what I do now, and led me to how I do it the way that I do it now, is because I, like to say that I'm not prophetic. My daughter, our oldest daughter's due date was yesterday. Well, I prophesied that she was going to go into labor on Saturday, and I failed that prophecy. So my point is, I'm not a prophet, but I'd have to manage wealth dispassionately through the next crisis, because there's always going to be a crisis. And so I just have to have a process that guides me. And some of the theories that this industry relies on, I learned the hard way. It's bad science.
Got it. So what firm were you at when you were in the middle of the global financial crisis?
So I started with a firm that is now known as Ameriprise. And don't get me wrong, Ameriprise is a great firm, but that's where I was. So no disrespect intended for them. It's just a matter of, I felt strongly that I need to be able to be flexible. And that's ultimately what led me to creating my own RIA.
So you're at Ameriprise, right? The global financial crisis hits. You bought the new minivan, the new house, and you're pursuing the ancient wisdom of the masters, right?
Right.
And you're like, okay, something's wrong here. What's next? I know you went on a learning journey. But
yes.
Tell me about that journey? Where did you go? You said in your book your father was a historian who instilled in you a dedication to continuous learning.
Right.
Okay, here you are.
Right.
Everything you've learned isn't holding true.
Correct.
Where do you go?
So
What
that's
do
a
you do?
great question. That's a great question, Ben. I remember at the time I started this journey, after those scales fell off my eyes, I knew there has to be something different. I'm missing something. All right, well, what is it? I just started asking questions. I started asking a lot of questions. And if I would meet with a wholesaler or an industry colleague, or one of the benefits of Ameriprise is they've got this very large research team. And so I talked to them. I would just talk to everybody that I could possibly talk to and say, I feel like I've got the CFP designation, but I'm missing something. What is it? And I kept coming back to, or I kept being turned to either the CFA or SEMA. Those are the two designations that I kept, people kept mentioning those two designations. Well, Ben, I like to think that I'm a pretty smart guy, but I just don't know that I have the intellectual chops to pass the CFA. That is a beast of a series of exams, and my hat's off to anybody that passes those things. I just didn't think, number one, I didn't think I could do it. Number two, I know that it is a beast to study those even level one. I know people that have taken it 5 times before they finally pass. I don't feel like I have the capacity for that. So anyway, I ruled CFA out, but I kept coming to the SEMA designation, and I wasn't convinced it was going to help me. So I never pursued it. And then ultimately a CFA charter holder or a CFA candidate at the time, he mentioned the CMT to me.
Mm-hmm.
I've never heard of that one.
For our viewers, tell us what CMT stands for.
CMT is a Chartered Market Technician. So I had never heard of it before, so I started looking into that. And this is technical. It's technical analysis. So the CFA is very fundamentally driven. It has some exposure to technical analysis, but the CMT is all technical. And when I just remember starting to research that I felt like it was going to be such a new perspective that it would be worthwhile to start pursuing. And so I was going to register for the CMT exam, level 1, but I remember I couldn't register until like mid-January. The registration window hadn't opened for the next exam, but I was starting to talk to various people at the CMT Association and people who had the designation, and what should I be doing? Because it was like November when I made October, November when I made the decision. So it's like, I have some time. I want to give myself a little bit of a head start. And so they told me to read Martin Prang, read Kilpatrick and Stockton, and they gave me several other different names to start reading, and I started reading them. And
what called you about the CMT curriculum? What was it that resonated with you?
It was different. It was different. It was, again, technically driven. And I guess, Ben, it was so different. Like, that's why I didn't pursue the SEMA, because, and again, no knock against SEMA, but it just seemed like it was the same stuff repackaged into a different designation. And I felt like I had studied those things before. I don't need another course of studies of the same thing. I'm missing something. And so when I researched the CMT, it was just very, very different. And and then as I started reading Martin Prang, who, by the way, endorsed my book, which is flattering. I'm still floored that he was kind enough to even read my book. But then what he said about my book, just because I considered Martin Prang a mentor, even though I've never met him, just because I've read so much of his stuff.
Yep.
And then as I'm reading people like Martin Prang, I was like, this makes sense. So that's all. And then that just, it continuously encouraged me just to keep going down that path.
Got it. That makes sense. So, in your book, you call it the long-term myth.
Yes.
Your book challenges the conventional wisdom of just ride out short-term volatility for the long term. So, first of all, let that marinate for our viewers. Tell us about technical analysis and tell us, give us kind of the fundamental technical analysis 101 for our viewers. Sure. And then tell us how that helped you start challenging the idea of the long-term myth.
So first of all, the difference between fundamental and technical analysis is that First of all, both a fundamental analyst and a technical analyst, we are both trying to solve the same problem. Okay. We're both trying to find stocks, ETFs, mutual funds, bonds, whatever. It doesn't matter what asset class it is. We're both trying to find something that either we or an investor can buy that has a good chance of going up. We don't predict what's going to happen, but we're looking at, and I'll use the term, I use it a lot, we're going to look at as much evidence as we possibly can to say this stock or this ETF, whatever, there's enough evidence to suggest this should go up. The difference between fundamental and technical analysis, I like to say that fundamental analysis, a good fundamental analyst is going to tell you what should happen. A technical analyst is going to tell you, well, I don't know what should happen, but I'll tell you what's happening right now. Mm-hmm. And to me, the big difference is the epiphany that most people in this industry believe that you're either a long-term investor or you're a short-term trader. And I don't really think that's true. I think most people are really in the middle. Yes, most of Americans are not day traders, but I also would contend they're not long-term investors. It's just, are they invested for the long term? Well, yes, they are. They're 40 or 50 and we have a long runway to go. I agree with that. Amen. But if you're a long-term investor, why do you look at your monthly statement? Right? And so if you recognize that, my epiphany was I have to operate somewhere in the middle. I can't do the day trade, but clients are not going to hold on forever without some sort of short-term evidence. And so that's the gap. That's the big gap. And to borrow a cliche from the CMT Association, their podcast is called Fill the Gap. Well, that's to me what technical analysis is really doing. It's filling that gap or that void between fundamental analysis that says this should happen, but this is happening right now. And to some extent, a lot of us in the technical community are not going to answer the question, why? Why is this happening? I don't know, but I know that it is. Right?
Got it. That makes sense. So how is the, fill in the gap in regards to the difference between quantitative analysis and technical analysis? Are they different? Are they used differently?
Yes and no. I would argue quantitative analysis is, well, there's probably two different ways to look at it. A fundamental analyst is perhaps doing some sort of quantitative analysis because they're looking at a bunch of numbers, and you could argue that's quantitative.
Yep.
But when you say quantitative to me, I'm thinking of what we would call a quant. And a quant in the technical community is somebody that's arguably just doing an algorithm, meaning if this, and this are true, buy the S&P 500. If this and this are not true, don't buy the S&P or sell the S&P or whatever. It's an algorithm that's telling you what to do. And the reason you do it that way is because you can remove your bias. That's what an algorithmic trader is doing.
Got it.
Okay. A fundamental or a technical analysis is really just looking at stock charts, or they're looking at price charts or indicators like a MACD indicator. What is this telling us? Or on balance volume is telling us that, well, on balance, the up volume is outweighing the down volume, and that therefore is bullish. So a technical analysis is looking at all kinds of sub indicators. It's not just price, it's other things. But then there are other like me, we tend to be a price only shop. So I can understand what an on balance volume and MACD. I understand all stochastic. I get that. We just don't use it a whole heck of a lot, which is fine.
So essentially, you're trying to really look at the prices to determine supply and demand. Is that really how you're looking at it?
Yes. Yeah, absolutely. Because, if you understand basic economics, and basic economics is human nature. That's why economics is the dismal science. It's just the study of human nature, and then human nature doesn't change, right? So what we have a tendency to do today, we as a people have a tendency to do 50, 60 years ago. I remember several years ago reading, an acquaintance of mine suggested that I read Alexander Hamilton, the book by Ron Chernow. It's a book, it's about, 800 pages long. It's huge. Actually took me quite a while to get through it because Ron Chernow is famous for his $20 words, but I eventually got through it. But I remember, Ben, when I was reading it, there's a proverb I think it's actually in Ecclesiastes in the Bible. It says there's nothing new under the sun. And I'm reading this Chernow's Hamilton, and I'm thinking, wow, there really is nothing new under the sun. Today
Mm-hmm.
we have Fox News and CNN News. Well, back then they had the Federalist and the Anti-Federalist newspapers. It's the same thing. So
Yeah.
human nature doesn't really change, and it shows up in a stock chart. And if you're
Yep.
looking at a stock chart, they are not prophetic. They are suggestive.
Got
Okay.
it.
A stock chart is not prophetic. It's not going to tell you what's going to happen, but it does suggest what might happen. It's suggesting that the bulls are outweighing the bears, and therefore the demand is outweighing the supply. And if
Yep.
you know your economics, that pushes price up.
That makes a lot of sense. No, I think you explained the difference between quant and technical analysis quite elegantly. And I think the supply and demand is what kind of brings it together in my mind. And you're operating on basic economic principles. Are you going to get it right all the time? No, but I think it's interesting that more fundamental analysts don't look at that, right? That idea of supply and demand to determine entry points, exit points, whatever the case may be. And if you really tie this together, like to kind of like if you have the myth that we are long-term investors, right? Why we look at our statements. Everyone is looking at that. We don't want to see that drawdown. And like in your book, you write a lot about the geometric asymmetry of loss. Tell us about that.
So this is math that most people have never done. And I've got my book, as you know, remember, has got lots of charts and graphs. And this one there's a table that shows you the math. If you take a 5% loss, I believe the math is you have to get a return of 5.3% in order to get back to break even.
Mhm.
That's manageable. That's doable. If you take a 10% loss, I think mathematically you have to get an 11.1% rate of return. That's
Mhm.
also doable. But
Yeah.
beyond that, it becomes really, really hard to get back to break even. So simple math, if you take a 50% loss, most people don't realize you actually have to get 100% rate of return to get back to break even. And some people would say, well, a 50% loss, that's crazy. Well, no, not if you're a buy and hold investor. There's multiple times where things like the S&P or the NASDAQ will go down 30, 40, 50, sometimes 60 or more percent. So if you're just holding for the long term, you're ultimately sacrificing some opportunity cost. In my book, I use the example of Cisco. Cisco is a great company. There's a lot of Cisco employees in the Raleigh-Durham area. I'm in Cary, North Carolina. So Cisco is not far from where I'm sitting right now. So during the dot-com crisis, Cisco continued to report fantastic fundamental stats.
Mhm.
But the stock was already down 30%, and it continued to go down. And so you can believe in Cisco. And again, Cisco is still around. Cisco is
Mhm.
still a very important player in the technology landscape. But
Yeah.
how long did it take for Cisco to get back to break even from the dot-com crash to back to break even? It's like 25 years.
Yeah, it's just getting. I was reading something about it the other day. It's just getting there.
Yes, it has reclaimed that point, but and some people would say, well, I'm not invested in one single stock. Well, you are if you work there.
Yeah, but
Right?
even then, in these kind of, and going back to the start of the podcast, these once in a lifetime things, Ted. Don't worry, stick it out. Once in a lifetime. I read that it's every 8 to 10 years. There's some sort of cycle. It may not be 50% every 8 to 10 years, but there's some sort of recession, some sort of thing that happens that where stocks will. It's not out of the range of 20 to 25% losses every 8 to 10 years in the market.
Right. And the reality is, regardless of where you sit in the political spectrum, I have a hard time finding anybody that would disagree with me when I say something like, there's another bear market coming. There's all kinds of reasons why we could argue there's another massive market correction coming. Now, don't get me wrong. I'm not predicting that. I'm not saying it's going to happen this year. I'm not saying it's going to happen next year. I don't want it to happen. My job and my life are a lot easier when we have bull markets, right?
Yes. Yep.
But when you study history objectively, you can't unsee these types of crises. And if you're about to retire and we go through this major market correction, what does that do? Well, that's going to impact your timeline. Maybe you're going to be forced to keep working. It's going to impact your confidence. It's going to, and it arguably can impact your legacy. And so there has to be a decision metrics that you can use to say, you know what? Maybe I need to sit in cash. Maybe I need to, and it's not your gut. That's not repeat. You can't repeat that. Not regularly.
Yep. So in your book, you have a lot of critique of modern portfolio theory and its reliance on standard deviation. And you think it's fundamentally flawed when applied to real world risk management. Talk about that and connect it to your kind of your core technical analysis approach.
So I got to tell you a story, Ben. The book started because I wrote it a white paper. And I wrote a white paper because of marketing purposes. I won't bore you with that part of the story, but when I sat down to write the white paper and I started writing, most retail financial advisors have never actually read Harry. Wait a minute. I've actually never read Harry Markowitz's work either. And so I bought Harry Markowitz's book, Portfolio. I can't remember the name of the book, but it's an expanded version of his dissertation. Yep. Markowitz's dissertation was in 1952, I believe, and it is arguably the linchpin, if you will, of what most people call modern portfolio theory. Other people, Fama and French, and other people have added to Markowitz's theory. But the point that I was trying to make is I had studied the Cliff Notes version of Markowitz. So I felt comfortable saying what I was going to say, but I realized I had never actually read his full treatise. So I read his full treatise.
Yeah, got it.
And it is insanely dense on math. I was really good at math, but not that level math. So I'm not going to critique his math. I assume his math is correct, but in order to make the math work, he had to make some observations and he had to pin them, like standard deviation and correlation. And these things have to be constant in his math in order to get his dissertation and his graphs to work. Well, the reality is correlations are not constant. They change constantly. And I would argue they are much higher today than they were in 1952. Most people are not realizing that. And the standard deviation is the bigger problem. Okay. Actually, I would call them, they're both really big problems. The problem with standard deviation is the amount of variation from the mean. And the mean is the average. So it's the average plus or minus. Well, the reality is clients don't care if you're above average.
Yep.
They only care if you're below average. And so why are we using standard deviation in our calculations? Well, again, it's overly simplistic. And again, I'm trying to critique Markowitz's theory. I'm not trying to critique Markowitz himself. Markowitz was obviously very smart and he deserves the PhD, he's now deceased, but he deserved the PhD that he got. I don't have a problem with his theory. I have a problem with the theory being relied upon today.
Yeah. Things have changed.
Massively.
Massively. Yeah. When you're talking about the correlation of between bonds and stocks, right? Right. There was a 40-year secular bull market from 1980 to 2020. In your book you talk about it being over, and that because this correlation is broken, it has a lot of ramifications on having 60-40 portfolios. Tell us more about that.
So just this past weekend, I was looking at, I won't name the individual, but I was looking at a very relatively famous individual who's got a quant model out there, and the quant model that they're making some decisions based on this quant model's reading, it's still 25% in cash. Now, if you understand where we're recording on August 10th, why in the world is the model still at 25% in cash? Well, we looked at, there's some of the inputs on that quant model are based on interest rates. That might be the problem right there, because the interest rate environment is different. We are no longer in a secular bull market for bonds. And so that is going to change how bonds are going to act. When I was starting off in my career, we're still in that secular bull market for bonds. We're still arguably in a declining interest rate environment. Well, interest rates decline. That means bond prices go up. It's a
Usually that's,
two-time or a seesaw, right?
Yep.
And so now that we're in a rising interest rate environment, that means bonds are going to behave differently. And so, again, reading an economist this morning that I tend to agree with an awful lot. And his argument is that Chairman Warsh is more likely to cut interest rates than raise interest rates. And he argues why, and I won't get into that. But the point is, there's a strong argument that we're in more of a secular rising interest rates for bonds, even though every once in a while, interest rates will go down.
Yep.
My point is, I believe strongly, and the evidence I would suggest backs this up, that you've got to manage your bonds tactically. You can't just put 40% of your portfolio in bonds in today's world because we're not in a secular bull market for bonds. That's not true. Now, there might be that, by the way, the same economist was talking about how he still believes that we're in a secular bear market for bonds, but cyclically, he believes we're in a bull market for bonds. So how do you reconcile that? Well, you can be bullish and bearish at the same time, but your time frame is different. And that's kind of my whole point.
Yeah. So you got to manage the time frame well, and obviously estimating that time frame, that's where the rubber meets the road. And I'm assuming you can apply technical analysis to bond prices as well to look at supply and demand to kind of see what these kind of mid-range frequency timeframes are.
Sure.
So you also in your book, you talk about kind of standard ways of static rebalancing of portfolios.
Yes.
Yeah. I kind of see from what we've already talked about how that can, your technical approach, how that can cause you to rebalance in different ways. But explain it more for the audience.
So traditionally, again, growing up in the business, we were taught that we should be rebalancing the client portfolios at least once a year. And the whole concept of rebalancing is, let's just go with a very simple example, 60% equities, 40% bonds. If the stock market does well, then the 60% of your portfolio is now, let's just make it simple, it's now 70% of your portfolio. Because they outperformed bonds, and now your bonds, therefore, are no longer 40, they're now 30. Well, the idea of rebalancing is sell some of those equities and put it back into bonds to bring your portfolio back to that 60-40 balance that is allegedly appropriate for you. Well, that's the theory. The problem with it is you're effectively selling your winners and you're buying losers. That's effectively what you're doing when you're just doing a static rebalance. Now, don't get me wrong.
There's no evaluation of
Correct.
Of what's going to be doing better in this next year, 2, 3, 4, 5 years when you make your rebalancing decision, essentially.
Correct. And therein lies some of the value, Ben, because if you're doing a rebalance, you're effectively saying, well, I don't know what's going to happen, so I'm just going to go back to my original allocation. But that's still an active decision that you're effectively saying the decision I made last year must still be correct. I'll just go back to it. Versus I'm saying, I don't think that's appropriate because maybe we should just let the equities continue to run for a while. And there's also the argument that just because it was 60-40, maybe you really want to be 60-30-10, like 60% equities. So trim some of those equities, but I don't want to buy any more bonds. I'm going to leave the 10%. I'll just put that in cash. That could be appropriate. And so in a 401k where you don't have a whole lot of choices, don't get me wrong, there's definitely some benefit to rebalancing if no other actions can be made. But a big part of the point that I'm trying to make in the book is that I believe you need to manage risk actively. And that means you need to have a process to determine, are we in a risk on period or a risk off period?
Or a sideways period, as you talk about in the book.
Correct.
Yep. So but I imagine you're doing that for both your bond and your equity positions and evaluating them separately, right? Or maybe there is some sort of correlation in it depending on the regime we're in.
There definitely can be an increased amount of correlation. That's part of what people are not realizing. As far as the money that we're managing, Ben, we actually don't have a whole heck of a lot of bonds or fixed income in our portfolios. For the most part, we are using some other indicators we're managing risk differently. And so the realization is that most people put bonds in a portfolio because they want to dampen down volatility. They're trying to manage risk by increasing or decreasing their allocation to bonds.
Yep.
And I understand that based upon all the academic research. My problem is I've read a lot of that research and I don't agree with it. I do agree, however, that we need to manage your risk. And so we're going to manage risk actively. And if we're in a robust, thriving bull market, I want to put put the pedal to the metal. Let's lay the hammer down on the accelerator or the throttle. Let's go. Yep. And then at some point, we want to take some profits off the table and maybe de-risk the portfolio because, hey, this is on the horizon or things are getting a little extent. For example, we sold half of one of the stocks that we have in our models this morning, not because we think it's doing anything wrong, but just because we know the stats of our tactical approach. And we say, well, that's above average. So let's go ahead and ring the bell on some of that because, you've ever heard the cliche, buy low and sell high?
Mm-hmm.
That only works if you sell high.
Yeah, it's true.
Right. So you actually have to have the discipline of selling high every once in a while. And so that's my point. And a large part of this too, Ben, is that you have to recognize that trading costs today are different than they were when Markowitz wrote that paper in the 1950s. Not to make myself sound really old, but I've been doing this now for almost 30 years, and trading costs have changed during my tenure as well. Back when we were at Ameriprise, I want to say initially, back in 1999, before E-Trade came out, I think our trading costs were like $60 a trade.
Yeah, it's insane.
That's just one way. So you do that both ways, that's $120. Then E-Trade comes out and now we have the price compression. It's really compressed down. Effectively, all of our trades clear through Charles Schwab today, and there's effectively zero trading costs. And 70% of the money that we manage is inside of an IRA. So when we trade, there's no tax consequences and there's no cost. So why wouldn't we put the client into a protected position? Because if we're wrong, we can just go right back over there. And that's the epiphany. It's the cliche that I've started to use is guardrails and then growth. Okay. I want to put a guardrail around the portfolio. I want to protect the portfolio, the wealth that the client has accumulated. Yes, we want to grow the portfolio because we want to make sure that we're maintaining our lifestyle in retirement, or I want to leave a lifestyle, a legacy for my kids, whatever. Yes, we want to grow the portfolio, but I got to protect it first.
You can't have the 25 or 50% losses. That's your primary mantra.
Correct.
Yep. Correct. So in your book, you talk about something called the vertical speed indicator, which is a combination of 14 binary technical indicators. Tell us about that.
So I want to try to, when I'm going down this road and creating the process that we now use, I wanted to have a system that I could use that would help me be dispassionate. Are we in a risk on environment or a risk off environment? Well, how do you know? Well, I put 14 different risk indicators, and these are not risk indicators that I've come up with. They're common. A simple example is the 200-day moving average. 200-day moving average is just the average price over the last rolling 200 days. So if generally speaking, if price is above the 200-day moving average, that is a bullish indicator for that stock or index or whatever. Conversely, if it's below the 200-day moving average, that's bearish, generally speaking. But is that always right or is it always no? And that's why I put 14 of those different indicators and I roll them up into one, and it's kind of a weight of the evidence. If it walks like a duck and it quacks like a duck and it smells like a duck, I'd be a duck. Right?
Yeah.
And so if the majority of my risk indicators are pointing to a risk off environment, maybe we're in a risk off environment, even though I don't feel like it. I feel that it doesn't matter what I feel. All the indicators, the evidence is telling me, be careful.
So do all these indicators in some way, shape, or form have something to say about the supply and demand of a given security? Did you say that? No.
Because if that's true, then there's little value in 14 different indicators that are all looking at the same thing.
Got it. Okay. So some of them are looking at supply and demand. Others are looking at other, how should I say? I'm trying to connect this in my mind, right?
So let me put it to you this way.
Yeah.
So some of the indicators are going to look at price.
Yep.
Some of the indicators are going to look at breadth. Some of the indicators might look at momentum, right? And so you're trying to get different indicators that can put together a compelling message. But again, if there's too many of the indicators that are all looking at the same thing, there's not really a diversification of indicators. You just have 14 different things that are all saying the same thing. There's no benefit to that.
Got it. But I guess where I'm coming from is, if you're looking, let's say, at a 200 moving day average, right? If it's below that moving average, what is the fundamental principle behind that which says, or is it just an indicator, a principle that says, well, why is this a bearish if it's below the 200 moving day average or above the 200? Or is it just a preponderance of evidence where companies that are above their 200 moving average have a tendency to go up, versus companies that are below their 200 moving day average have a tendency to go down?
So I don't remember who said it. It's probably been said multiple times, but the cliche in this business is there's nothing good that happens below the 200-day moving average.
Yeah.
So if the 200-day moving average is sloping downward, for example, well, that's in clear distribution, right? The challenge would be, and the reason that this cannot be the only binary signal that you have, you could look at energy up until prior to the Iran war. If you looked at energy and you zoomed out and looked at a weekly chart, energy was kind of going sideways, right? And so what's that 200-day moving average doing? It's going sideways.
Yeah,
and so
exactly.
During that time period, there's going to be a lot of times where that energy sector, XLE in this case is how I was measuring it. XLE is above the 200-day. Now it's below the 200-day. Now it's above the 200. So you can't just use that by itself. You've got to layer in some other things. And that's why I've got other indicators that complement it.
Got it. So switching gears a little bit, it seems that you're not really strictly allocating across asset classes. Instead, you're allocating across strategies. So tell me about these strategies and an insight into how you build portfolios around them.
So you were asked earlier about quantitative versus technical. Well, most of our clients have exposure to 4 different equity strategies. 2 of them are quant-based. 2 of them are tactical. So the quant models are just 2 different ways for us to look at something. And by the way, the VSI indicator, that is a quant model. If the VSI is on a buy signal, hey, buy. If it's on a sell signal, go to cash.
It's an algorithm of those 14 different indicators, basically.
Correct. And again, the value of that is I can take those 14 different indicators and I can determine when the buy signals and the sell signals were given, then I can dump it into the computer. I use Optima, and Optima will then run a back test to say, and I have that back test from 1999 till today, what would have happened if I bought the S&P 500 when VSI is on a buy signal and went to cash when it's on a sell signal? That's a quant model. And so that's one. We have a second quant model. And the reason we have a second quant model is my VSI is not perfect. And again, the VSI is proprietary and it's just 14 different indicators. I have a friend who has something similar. He calls his an MRI. I actually mimicked mine off of his, but his is very different. And he and I compare notes. What's your MRI? What's your VSI? And sometimes I'm on a buy and he's on a sell. So that's why I'm using 2 different quant models. And then the tactical approaches are much more looking at the buy, the demand and supply side of things.
Got it.
And for example, we're looking at what we will call a setup where we believe the bulls appear that they're going to outweigh the bears. And some would call it a breakout strategy. And so that's when we'll put a buy on. And it doesn't matter to us if we're very, very concentrated as long as that's working. So there's a couple of different sectors that we're kind of heavy in right now that historically we wouldn't be in, but we're there because that's where the setups are coming from. And I've long joked that most of our clients, this is kind of how they do their fundamental or their analysis. So they get their Charles Schwab statement, they rip it open, they look at the opening balance, they look at the closing balance. Hey, honey, what's for dinner? right? That's their analysis. They don't, very rarely do they get back by page 2 or 3. So do they care that they're heavily invested in this sector or that sector?
No.
Nope.
Yep. Yep. That's interesting. So let's talk about your firm in general, right? I understand that unlike a lot of RIAs who do internal quarterly review meetings of client portfolios, you're doing daily meetings on your client portfolios. Tell us a bit about that.
So we manage at a model level. And the reason you manage at a model level is because it's the only way to maintain your sanity as well as maintain your finger on the pulse of what clients are experiencing. Back in, I think it was 2009. So the back end of the global financial crisis, I was actually able to buy a practice in another town. And so for a number of years, I actually had 2 offices. I've since sold that branch. But when I bought Advisor, he then retired. And for a while, he was going to do some consulting with me, but I just to make sure that we made the connection with the clients. But ultimately, make a long story short, what we found is that just about every client had a different portfolio. And there's no way in the world a retail financial advisor can keep their finger on the pulse. And that, we have about 165 clients. There's no way I can keep up with 160 unique portfolios. That's not tenable. Okay. And anybody that says that it is, they're not telling you the truth. They can't be paying attention to that. And so that's why we manage at a model level. And so if we're going to buy XYZ, I'm going to buy it in this particular model. And whoever has exposure to that particular model is going to get a portion of that. Now, what's interesting too, Ben, is I believe fractional shares have just gone live in Charles Schwab. So that's going to change some of how we do some of our models. And this goes back to my whole point about the book that I'm making the book is that so many people in this industry, they're clinging to theories and realities that don't exist anymore. We don't have transaction costs. And if the majority of the money that you're managing is inside of an IRA, so you don't have tax consequences and you don't have commissions or transaction costs, why wouldn't you make the change? And now we can buy fractional shares. That's huge. So now, one of our models is what we call sub 25,000. So this wouldn't surprise you. We have a client that might have $1 million IRA, but they only have $25,000 in their Roth IRA because Roth IRAs didn't exist when they first started, when they were towards the end of their career. And for whatever reason, we haven't done Roth conversions. We won't get into that. But the point is we have sometimes big clients who have small accounts or we're taking care of a kid or a grandkid. Well, now that's
so you can execute your full strategy because you can do fractional shares.
Correct.
There you go.
That now
that's very interesting.
I think this went live last week, so I haven't looked into it just yet, but I'm pretty sure I'll be able to.
That's fantastic. So I guess managing money the way you manage money, and this is from my mouth, not yours, is that you're trying to prevent the big losses, right? Have the guardrails, and it's kind of from your mouth, but I want there's no promises here of that you're making in any way, shape, or form. But the attempt is to prevent the big losses, and then to grow, and also to grow the portfolio, and because you don't have to spend potentially years, hopefully, having your clients catch up because they experience those big losses.
Correct.
That's what underpins. Correct. The goals of how you're trying to manage money. Correct. When you talk to a new client, what is it like to get them to buy in to not having this individualized investment strategy tailored to them? It doesn't mean you don't do the financial planning and all the other things tailored to them, which I assume you're still doing. But you got it. Do you have to get them on board with you managing money the way that the way your models that?
Not really. Because it's usually like I had a conversation with a prospective client this morning, and I don't think we're going to proceed. I think he's looking for something that I'm not providing, and I'm not going to change my strategy just to win the client.
Got it.
So normally when we meet with somebody, I agree with your distinction is solid. The financial plan, that's custom. That's unique. What's going on and the advice that we're giving you is unique. For example, about the Roth conversion as a simple example. Roth conversions are great, but they're not universally great. So we have to factor in your situation. What are your fixed, et cetera. But the portfolio, once I explain what I just explained to you, that we can't keep track of 160 different holdings in a portfolio. We can't pay attention. And I assume you want us paying attention, right? Oh yeah.
Yep.
So once they realize it, it's, oh, I get it.
Yep.
So that's really not that hard to overcome. It's just, many people are not used to hearing people talk like me say things that I'm saying.
Yep. So I want to end this on a couple things. One, where can they buy your book?
Amazon. You can probably get it. I'm sure you can get it at Barnes and Noble and Walmart. But it's been a long time with somebody who doesn't have an Amazon account. So yeah, you can get it on Amazon. There's
tell the audience the name of the book again.
It's evidence-based investing. To invest well over a long term, sometimes you have to first survive the short term. But if you just Google or go to Amazon, evidence-based investing, they'll find it.
Yeah.
And you can also get the introduction and the first chapter free at my website, theodorehicks.com.
Got it.
There's also an Audible version and a Kindle version as well.
So if you wanted to leave the podcast listeners with one last thing, one to know about you or your firm, what would that be?
I'd say question everything. That would be the first thing. Question everything. And that's kind of the whole point of my book. You read my book, Ben. I'm not trying to provide you the answer to my book. I'm trying to provide you with the permission to question what you're hearing from so many people, whether it be academia or Wall Street or the financial news media. I think I'm really just trying to empower the average American or the average industry professional to question what they've been taught.
That's fantastic. I couldn't agree with you more. My dad was very similar to your dad, and he taught me to always question as well. And Scaling Alpha listeners, we're so happy to have Ted on our podcast today. And I would say thank you so much, Ted, for being here. We really appreciate it. And everyone, please always question.
Thank you. Appreciate the invite, Ben.
Thank you. Thanks, everybody. Till the next episode, we're signing off.